Hi, this is Alan Mandel at HTDT Gold in New York, 75 Wall Street, with my report for November 21st, 2013. It's been making news that gold hit a 3-month low recently, trading today at 1242. This came as the Fed released minutes of its previous meeting saying that they might taper sometime in the future. This is nothing new. Everyone knows that tapering will occur at some point, probably in mid-2014, maybe a little bit later than that. But the fact is, gold had been weak before, and this was another excuse to sell. It's good now to possibly reflect on why I advocate owning gold and silver for future price rises. And that is because it's protection against political turmoil, financial and dollar drama that could play out in the market fairly soon. It's said that, well, if you buy gold and silver, you're really betting against the economy. I don't see anything wrong with that. I see it's reasonable to expect that things will unravel as time goes on. With this Fed bond buying program, $85 billion a month, the economy is only sluggish. It hasn't really improved a lot. Unemployment is 7.3%, and Janet Yellen, who today was confirmed as the next Fed chief, isn't going to be satisfied until unemployment is 5.5%. But as unemployment drops below 7%, you're going to see a lot of inflation. People are going to be chasing goods as prices rise. Also, we're exporting this theory that liquidity will improve all situations to Europe and to Asia. In Europe, growth is no better than minus 0.4%. And the EU yesterday said that they'll push rates negative, which means banks are paying you to store your money. And that's going to stimulate rising prices and a crisis. It's only a matter of time before this unfolds. Balance sheets are very weak. European banks are keeping depressed real estate, mortgages that are underwater, about half of them which are underwater. They're keeping them at full value on their balance sheet in anticipation that the loans will be paid back. Fat chance. Back in the United States, manufacturing activity is going down. It's still above zero, which is the dividing line between growth and recession. But the Philadelphia manufacturing report released today showed that it was declining in activity. Producer prices are falling, consumer prices are flat, crude oil prices are falling. Everything looks good, but it isn't. Inflation is going to come back. Iranian negotiations may break down and push crude oil prices higher. So there are a lot of things out there. Also, there may be a real estate bubble forming in the United States because the only benefit from this bond buying program, this extra liquidity, has been the push up of asset prices. Stock prices are at all-time highs and keep moving higher. So at some point, this is going to unravel. There will be unforeseen crisis depending on how the dollar drops when the bond program ends. Interest rates are moving back up towards 3%. They were 1.3% last year. And we'll just have to be patient and accumulate gold and silver while prices are low. This is Alan Mandel, HTDT Gold in New York.